Let me show you today what are the three most important indicators you have to put inside your chart time frame for forex trading. Okay, we talk about moving average, in particular 200 period moving average, 21 period moving average, and in blue 7 period moving average. What's the difference from 200 moving average and 21 period moving average? 200 period moving average is a slow moving average, okay? On the contrary, 7 and 21 are considered a fast moving averages. When a slow moving average like 200 period cross at the downside a fast moving average, okay, you have a downside period. Look at this. Look, it's incredible, this example. Here, the 21 moving average cross to downside 200 moving average. So, a downside start. On the contrary, okay, here the 21 moving average cross the top side the 200 moving average. So an upside start. Okay, recap. A 200 moving average, okay, is the line which the market gets to separate a bearish market to a bull market. Okay, we are here in the hourly chart time frame, but the same is if we look for 35 minutes chart time frame. How here you can see how the trend is at upside, okay, near the moving to average at 200 period. Okay, let's go back to hourly chart time frame. Take a look. Here, okay, we are at downside period. Okay, the market is going down. Okay, what's happened? Take a look. What's happened when we have a market bear? When we are in a time frame, in a chart time frame where 21 period moving average cross at the downside 200 period moving average. Okay, when this happen, okay, it's simply to trade if you are on hourly chart, because you have to wait for a white candle, then a black candle, and the market go down. Again, a white candle, then a black candle, and the market go down. Here again, a white candle, a black candle, and market go down. White candle, black candle, and market go down. Okay? Okay, take a look. This is another good example when the market is below 200 moving average, okay, and 21 moving average period cross at the downside together with the 7-period moving average, the slow moving average 200 period. Look, you have a white candle, then a black candle, and market go down. Again, okay, when you have a white candle followed by a black candle, then the market go down. And again, white candle, black candle, and market go down. When two consecutive white candle, okay, the price rise, okay, but when you have an interruption of this rise, and so again a black candle, market go down again. Okay, so you can consider 200 moving averages are like your red line from the bear market to the bull market. When the candles are below the 20-period moving average, market is at the downside period. When, on the contrary, the candles are above the 200-period moving average, the market is at upside, okay? Below 200-period moving average, bear market. Above 200-period moving average, bull market. Okay, take a look daily chart. Look, when the 200-period moving average is above the candle, okay, it's a bear market. When, on the contrary, look, the 200 period is below the candle, you have a bull market. Look at this. Yeah, the candle rise. 200 moving average are below the market. It's a bull market. Here, on the contrary, the bear market start because the 21-period moving average, that is a slow moving average, cross at the downside the 200 moving average, that is a slow moving average. So a fast moving average cross at the downside a slow moving average. The bear market start and price fall. So if you want to check where the market is going to, you have to use the 200 period moving average, okay, to separate the bear market to the bull market. I hope this video will be useful for you and for your trading. Give me your like, share, and take a look. See you.